So what does the taper mean for your portfolio, and is it time to taper-proof your investments? We turn to Vince Lowry for some guidance here. He's chairman and CEO of RevenueShares. And Vince, thanks for coming on the program. Let me begin by just asking you, thank you. You know, before we get into any strategies on what people should do with their portfolio, just start us off with, is the taper a good thing? How should investors be feeling about this taper, or is trouble ahead?
Well, I think it's very good that the taper is occurring. It probably went along a little bit further than what they wanted to do, because it's kind of artificially kept interest rates lower, which makes it difficult for banks to really commit their capital and make long-term loans for businesses and mortgages. So it was having a negative effect, and I think it's good to get rid of it, and the faster the better, in my view.
You know, you're in Philadelphia, Vince. One of my good friends and fellow Philadelphian, Jack Bogle, often says, don't just do something, stand there. Is this the time when you want to do less rather than more in your portfolio?
Well, I think so, Tyler. That is a very good strategy, is to just stay long the stock market, be overweight the stock market right now, and overweight corporate bonds.
Corporate bonds, obviously, you're saying by implication, stay away from treasuries. I assume you mostly mean longer-term treasuries, and stay away from REITs, which might be sensitive to interest rate moves.
That's right. I think the REIT market, the entire market, especially in the financial sector, those real estate investment trusts, some of them are trading anywhere from 5 to 10 times one-year annual revenue, which is just unsustainable. So I would stay away from that. In terms of the corporate bond, we may be in an era not dissimilar to the 40s, 50s, and early 60s, where we're at a generation low for interest rates. They will rise slightly, but not by much.
All right, so let's talk a little bit about stocks. You said, you know, stay into stocks. Let's go into that a little bit deeper. What kind of stocks? What kind of sectors? And U.S. or international?
Well, you know, when we're in an economic recovery, and we are, what we monitor is the revenue growth of the S&P 500, and it's moved up from last year from about 1.8% to about 2.8%. What that means for stocks, especially globally, if we continue expanding the revenues and they grow just a little bit more, we get to 4 and 5%, and the normal's around 6 to 7 in an expansion. This is going to be very good news for emerging markets. It's also going to be good news for large cap stocks, because they have really cut costs over the last several years, and that's going to be bottom line. Top line numbers going to hit the bottom line in a much bigger way going forward.
Big caps, small caps, no caps, what?
Well, the large caps, but I think that the mid cap and small caps, although they will do well, I do think, and they've been doing well for the last 10, 12 years, I do think that large caps are going to begin to outperform as the economy. If the economy can grow and revenues can grow to 5 or 6%, you want to be more concentrated in large cap.
Okay, Vince, real quickly, we have a few seconds left. When should investors begin making changes in their portfolio? The taper doesn't officially begin until January. Do it now or wait?
Well, I think that right now what they should be doing is, for their bond portfolios, is overweighting the corporate bonds, go into mortgages, corporate bonds, and maybe some high yield. I think that the economy is going to be strong enough. We won't have problems in high yield, and begin to move there. I'd also be looking at dividend-paying stocks. I'd be moving into utilities and energy stocks right now. I'd be overweight those sectors.
Okay, all right. We're going to have to leave it there. A lot of good information, though. Thanks so much, Vince. Vince Lowry, Chairman and CEO of RevenueShares.